Hello, everyone. It is oops, there we go. It's a good thing I have my headphones on. Hello, everyone. It's good to see you. And welcome to Financial Literacy for Business Owners. I am really excited to be doing this today. This is one of my very favorite ones to do just because I've got a lot of people who come to me that don't understand the finances side of things. They know I've got a background in accounting. They think that because I've got this background in accounting, or that I'm going to teach them all that they need to know about accounting. I'm trying to make them into mini accountants. The good news is that you don't need to know a lot of different things about accounting to be financially literate. So for those of you who are coming in here, you're business owners, I'd love to know a little bit about you. Tell me where you're from right now. Let me know where you're at, and maybe let me know what business that you're in, and maybe what you don't really understand about finances. Like, what are you here to learn? What are you hoping to understand? I want to wrap this into something that's relevant for each one of you that's on the call. And this will be available on replay at the end, by the way, for those of you who are going to ask the question. And I know there's lots of stuff going on right now in the holidays, and you're thinking, I can't stay totally plugged in. But the fact is that you're here so you can learn this and be financially literate as a business owner. So I'm really excited to have you guys here, and we're going to get right to it. So a couple quick things is first and foremost, I know that you're on your computers, I know that you're on your phones. Some of you are watching. I can see that you're watching on YouTube right now. That's totally fine. But either way, I just want to make sure that you are not going to multitask, because there's no point in multitasking, because we're going to get into a little bit of the weeds here about what specific things are going to be relevant for you as a business owner. So, and you're not gonna be able to do that if you're going to be distracted. So over the next 55 or so minutes, I'm going to give you some of my very best stuff around financial literacy, and it's really not complex. So I just want you to understand that for some of you who might be a little bit freaked out about like, I'm not a numbers person. How many of you out there? Again, you guys are a quiet bunch today. Let me know where you're from. If you just joined me, let me know where you're from and what business that you're in. But also specifically, what are you, I know a lot of people are thinking, well, I'm not a numbers person, but the reality is this. Here's some good news, is that accounting and bookkeeping and stuff like that, it's not about numbers as much as it is about rules. And if you understand rules, if you understand like things like the speed limit, and you understand the game of solitaire, right? That's all it is, right? I'm not trying to make you into an accountant here. That's not necessary to be financially literate. So this is what I'm going to be talking about over the next few minutes. Peter, thank you for breaking the ice. Trail building in Iowa, vernacular and language associated with financial literacy. Excellent. Oh my gosh. Wow. Best practices to streamline entry like mileage. Okay. Not, streamline entry like mileage. I'm not sure that I'm picking up what you're putting down, Peter. I'll do my best, because I'm trying to read this rather quickly. Idris, Scottsdale, Arizona, financial services industry. Excellent. Okay. So you're building trails in Iowa. Is that what you're doing? So understanding the vernacular language associated with financial literacy. Okay. Sorry. I was trying to piece together what you're saying there. Okay. So best practices to streamline entry. Okay. Very good. All right. So you want using common vernacular to understand this. Listen, I'm all about that. I'm not about like right now I'm in a PhD program for organizational psychology, and everyone there just speaks like they just puked a thesaurus all over each other. And I can't understand half of what they're writing. And I'm like, okay, I'm not an idiot, but I can't understand this language at all. Why can't they just speak like normal humans? So that's not what I'm going to do. I'm not going to bury you in a bunch of phrases and words that don't mean anything to you. I want to make this very tangible every day for you. So I'm going to be doing a couple of things, some very basic 4-function calculator stuff that you can easily do. It's not hard to do. You can use it on an Excel spreadsheet or even just a 4-function calculator. So it's going to be really easy stuff. And so thank you for putting that out there and using common everyday words that people, should use, right? Let's see, Claudia. Hello, Claudia Richards. Let me know where you're from, Claudia. And Andre is from, Andrea. I apologize if I'm not pronouncing that right. California, and you're in the startup space. Very good. London, England. startup business in makeup for Black women. Very good. Excellent. Well, thank you guys for being here on time. We're going to get right into it. Again, just to make sure that you're not multitasking, so we've got a lot of things to cover. I suppose I should share my screen so you guys can see this. All right. All right. And for those of you who are coming in a little bit later, yes, you'll be sent a replay in your email. So my extension is markdolfini.com. It will probably wind up in your spam. So just keep an eye out for that for the next day or so. All right. So let's get to the agenda for today. So first and foremost, we're going to be getting to the Viper methodology, the Viper framework, which is how I recommend that businesses set themselves up with a top-down approach, top-down strategic approach. Then we're going to look at the 4 core functions of business. Every business has to have all four functions. Then we're going to look at the financial statements. We're going to look at balance sheet, income statement, P&L, things like that. And you're going to be looking at a phenomenon. Now, this is where we're going to get a little bit more advanced. So for those of you who are coming here and you're like, oh, I already understand balance sheet, income statement stuff, hang on to the end, because there's a phenomenon known as growing broke. If you're in a growing business, there's a phenomenon. In fact, there's lots of ways a company can grow broke. I'm going to show you one very common way, especially in an inflationary environment. So you're going to want to hang in towards the end so you can see that. And then, of course, we're going to talk about a couple of resources that I have that I can offer to you for continuing education stuff. All right, let's get to it. So I know some of you are just starting out. Some of you are wanting to scale. Some of you are wanting to get to the next level. Some of you are wanting to bring in more customers. And, and some of you may just want to have a day off once in a while. How awesome would that be? Or some of you maybe just want to get paid once in a while, right? Where you're not getting paid very frequently, especially if it's your business. This is all stuff that we're going to be talking a little bit about today. So I'm not going to get super granular, but I am going to get granular on a couple of different things. I just want to show you that. So these are all the books that I have written. I'm not here to sell books. They're all available on Amazon if you want them. I don't get paid very much from Amazon for writing books. Like, I'd have to sell literally a gazillion of them. And I'm not about that. So, I mean, I want to make sure that these are very, very good books. But the last book that I have written is called The Time Wealthy Advantage. So the reason I'm demonstrating this book to you is not to sell it. If you want to buy it, that's fine. But the reason I'm bringing this up is because this is where I highlighted the Viper framework. Now, the Viper framework is specific to my strategic approach to a business. So if you have a business, if you're in business for yourself, and generally that's the type of avatar that I attract, are people who are in business for themselves. And this is a top-down approach to creating a strategy. Tonight, if you're interested, at 7 o'clock, if you want to go back on EventBrite and register for it, I have another class, which is strategic planning. We're going to get through all the weeds on this stuff around strategic planning, but I am going to cover this really fast just right now. So the Viper methodology, the Viper framework, it stands for vision, infrastructure, process, execution, and reporting. So I'm going to get into the weeds a little bit on this, not a lot, but I just want you to understand this basic framework is top down. And let's first and foremost start with vision. Vision is made up of 2 parts. It's made up of your personal vision and it's made up of your business vision. Yes, I know we're here to talk about financial literacy, but the main premise of everything that we're doing is so we can make more money, so it funds our personal vision. True? It makes sense because many business owners who I have, sorry, my nose is running all of a sudden. It's actually warm here for the first time in like a week. So I'm here in the Midwest. It's been a very cold couple of weeks. So the personal vision, first and foremost, is going to ask you where it is that you want to go. Like, if your life was not defined by income generation, where is it you want to go? And that's a question that many business owners and many people who are very career focused do not ever take time to answer that question. What would your life look like from day to day if you weren't worried about income generation? The business vision is going to ask you a very simple question. You're like, all right, cool. That's your personal vision. That's where you want to go. How are we going to get there? And that's the business vision. The business vision should be reverse engineered to deliver the personal vision. The danger in never creating a business vision, the danger in never creating a personal vision, or the danger in creating a business vision before creating a personal vision, is that you end up creating a life that exists to serve the business. So let's talk really quick, just about 2 minutes on personal vision, just so you can get an idea of how to put a personal vision together so that these finances actually mean something for you. So when you are making more money, your business is more efficient in making money. Now you have something that you can direct it towards. So one thing that I like to do is come up with a 100th birthday speech. I really like the 100th birthday speech idea because it really makes you think. It projects yourself into the future. And I want you to think about who you want to be in the room at your 100th birthday speech. You're turning 100 years old. Who would you want to be there? Or, and basically, what would you say? What would be the message that you would want to give to people, to deliver to people, and for them to take outside the room after you're done speaking? If you're thinking like, dude, I'm in my 20s, like I can't think of like a 100th birthday speech. Okay, let's say you're 23. What about the next major milestone for you? Maybe it's your your 10-year high school reunion, right? That could be a milestone. Maybe it's turning 30. Maybe you're in your 30s and you're like, you know what? Maybe it's when your kids become teenagers, or when they become 18 and go off to college. Whatever that next major milestone is for you, it's a perfect opportunity for you to create a personal vision around. Okay, so just something to think about. I'm gonna put the fries in the bag and leave that there. But please, if you do nothing else, please take the time and the opportunity, especially this time of year. It's a fantastic opportunity to create personal visions. Specifically for your relationships. What do you want your relationship with your spouse to look like? I mean, I have a personal vision of what I want my relationship with my bride to look like. With my children, with my friends, with my relationship with faith, those sorts of things, right? So now let's look at the 3 C's of business vision. Now, this is foundational. So I'm going to spend a few minutes. So foundational means it's kind of broad. We are going to get to the financial literacy piece, but this is very relevant, especially when you're in a business that's trying to grow. So the 3 C's of business vision, first and foremost, are core purpose, core values, and client avatar. These 3 things, every time I have been invited in as a strategist to someone else's business, anytime that they've been struggling, it's because these 3 areas are not well defined. Any one of these 3 not being well defined, usually it's all 3 that are not well defined, that's when they're struggling. And they're struggling to make money, they're struggling to keep money, they're struggling for sales, they're struggling with employee turnover, they have culture problems. There's fights breaking out in the parking lot, things like that. So let's first and foremost unpack the core purpose. Core purpose is specifically what business are you in and what problems do you solve? And you got to be really specific on that. And if you're not specific on that, you're going to have a really hard time marketing your business and really trying to grow your business. And the reason is because people don't know what it is that you do. Right? Like what are specific problems that you solve? If you just say I'm in real estate, that's not specific enough. You need to be much more specific. Your core values are what the business stands for. Okay. So what matters to you about this business, and how would the world be worse off if you're no longer in business? Your company culture is defined by your core values, and your company culture and your company brand are inextricably linked. So when you have a very strong company culture, this is, yes, there will be a recording. Yes. Thank you. Thank you, Ariel. Ariel's doing my administrative work. Yes, thank you. So this is what I'm saying. Like right now, you've got to be really clear about what the core values are of of your company, because if you don't take the time to define this, I promise you it will get defined, usually by the person who's got the strongest personality in the room. And if that's not you, that becomes a major problem. And that means it always has to be you. So why not just take the time to organize and get your core values defined? And remember, we're just going to hit the foundations here. We're going to get into the other stuff here in just a hot second. So just bear with me. The last piece is your client avatar. Your client avatar is who specifically and ideally do you want to serve? And you have to be specific about this in terms of their geographics, their demographics, and their psychographics. Their geographics are where they are. Their demographics is obviously who they are. Are they married? Are they single? So forth. And then their psychographics is how they think and how they buy. When you're considering psychographics, you want to think of the phrase ALIA, A-L-I-A, their attitudes, their lifestyles, their interests, and their aspirations and goals. When you're clear on that, all of a sudden your marketing is more economically efficient. What do I mean by economically efficient? Yeah, you're not wasting money. if you're just trying to, let's say for argument's sake that you're overseeing your small business and you've got 10 different employees and you've got a small marketing department, right? You may be paying 1 or 2 people to do the marketing. Not only are you paying their salaries, but wouldn't it be nice to know that if they're putting stuff out there that's actually directed towards the people that you're trying to attract, that there's a metric. We're going to talk about KPIs here in a little bit, but KPIs, there's one that's called RMI, return on marketing investment. If you put out $10,000 worth of marketing, wouldn't you like each one of those dollars or each one of those euros or each one of those pounds to bring 3 back under each arm? Yeah, right. So you're like, okay, cool. Yeah, I mean, I can put out 10,000 units and have it bring 60 back. That makes sense all day long. That's where this is where, if this is not clear, if the core purpose is not clear, if the core values are not well defined, and the client avatar is just kind of anybody and everybody, you're not going to be operating efficiently when it comes to your marketing, when it comes to your sales. Your productivity is going to be inefficient, and it's just going to be very fragmented. So this is why all of this stuff ties together. That's why I'm hitting this stuff first. So that is the 3 C's of business vision: core purpose, core values, and client avatar. And that will put the fries in the bag on vision. Now, let's look at infrastructure. Infrastructure is just basically the bones of the business. It's the desks, the chairs, the software, the boring stuff that really no one thinks about. It's the websites, but it's also one piece of infrastructure that you have to have from an accounting function, from an accounting perspective. You have to have accounting software. There's no getting around that. And people who are doing stuff using all the free options out there, look, man, there's people who come to me that, and I have some pretty low priced options for strategic coaching and stuff like that. I mean, I'm not the lowest price for sure. I'm not anywhere. In fact, I'm probably among the higher priced. But the reason why, like when people come to me and they're like, well, what's the free version? Man, you're going to struggle with the free versions of most everything. Because when things are free, you become the product. And now you've got all these ads and you've got to work around all the other stuff. Just like, I'm sorry, but QuickBooks to me is the gold standard. I don't know why anybody else would use anything other than that unless they have a piece of software that's unique to their industry that becomes like an enterprise solution. An enterprise solution in the context of infrastructure means that it brings in the lead generation piece. It brings in the sales component, right? It brings in the operation and fulfillment component, and all of that is housed in one area, and it does all the accounting and bookkeeping and everything else. That's what we call like an enterprise or an ERP or an enterprise solution. Okay, so it oversees the entire enterprise. But this is something that you have to consider in the infrastructure for your business. If you don't have that, I can't tell you how important that is to put the infrastructure next. After the infrastructure, we talked about vision, we talked about infrastructure. Now let's talk about process. Now, one quick point I want to make about infrastructure. The reason infrastructure comes after vision, and I just want to make this quick point, is because everything feeds what? Everything should be feeding your personal vision. Everything should be feeding your personal vision. Because think about it for a second. Let's say Claudia, right, or Clara. Let's see, Clara is here, UK master student with experience in accounting and auditing. Excellent. Keen to learn on more explaining financial and management reporting to non-financial managers. Very good. So Clara, my degree, my undergrad is in accounting and finance. And I worked in the field of accounting for a number of years, did lots of different stuff, and then saw the light. I went the more entrepreneurial route. So good for you for having that much education. And this is all stuff that I think will fit with you hand in glove. But let's say for arguments, Claudia and I, we work together. I figure out she determines her personal vision is to lay on the beach for 2 months out of the year, rubbing cocoa butter on her belly as she's laying on a beach in Spain. Okay. So there she is. She's laying on the beach in Spain for 2 months out of the year, rubbing cocoa butter on her belly. If she comes up with an infrastructure, right? She designs an infrastructure that's going to require her to return emails and phone calls and, have to do journal entries all the time. That's going to be a miserable experience for her when she's laying on the beach trying to rub cocoa butter on her belly, right? So you want to have that infrastructure piece that's in alignment with that vision. That's why the infrastructure piece comes second, okay? So just think about that. So from the process perspective, process is simply how you do stuff. Then there's 2 components to process. Process has tactical components and it has strategic components. We're going to go over the strategic components in depth tonight if you're interested. That is, again, the strategic planning tonight at 7:00. I know for some of you, I know Clara, right now it's 9:00 at night, so it's probably going to be in the middle of the morning for you, but it will be available on replay if you're interested. So anyway, these tactical and strategic. So when you're looking at process from a day-to-day perspective, the tactical side of process is the day-to-day, how you do stuff, right? It's your standard operating procedures, your checklist items, day-to-day activities, right? It's kind of the boring stuff. It's how you answer the phone. It's how you your opening procedures, your closing procedures. It's how you prepare bank deposits. It's how you do your bank reconciliations. Just boring stuff like that, right? Day-to-day stuff that you just need to have SOPs written out for. Okay. We're not going to get too much more into that, but these are the sorts of things that you have to have written out from your standard operating procedures every day. Strategic planning, on the other hand, this is where you start thinking about people, purpose, and promotion. People, purpose, and promotion. This is when so think of your infrastructure and your tactical process. Think of that as the system. Think of that as the battleship or the warship that's sitting in the harbor. Strategic planning is going to say, cool, we've got this boat. Now we're going to take it out of the harbor and go make some trouble. That's what strategic planning does. If you don't have a strategic planning component, your boat is just going to be sitting there in the harbor getting battered by whatever economic winds happen to be blowing at the time. Strategic planning charts your course, not just whatever winds are blowing. Does that make sense? Let me know if that makes sense. So because this is really important. And again, I'm not getting into strategic planning right now, but the thing is, you have to have a strategic planning component. Who are the people that you're going to need externally, right? Who are your clients that you're going after? Who's, what's the, who do you need? It might even be great, Catherine. Thank you. This is like, who are the people that you're going after? Who are the people that you might need? You might need marketing help because you're not a marketing person. You might need sales help. You might need a trainer for your people, right? You need to think about the people component of the strategic plan, and you need to think of the people internally. You might need to be hiring some people because the people that you have just aren't cutting it, right? Or maybe you need they need training. When you think of the purpose, the strategic purpose is also in alignment with what? It has to be in alignment with your core purpose from business vision, right? Core purpose, core values, client avatar. See, this is why, and again, the strategic planning, the strategic purpose has to be in alignment with the core purpose, because if it's not, it's going to get weird, right? This would be like if the strategic purpose, let's say for argument's sake, that would be like, if it's not in alignment, it would be like if Starbucks started selling chainsaws. It would be weird. People are like, why? Wait a minute. No, I want to buy a coffee. I don't want to buy a chainsaw. But I'm like, yeah, but look, it's cool and it's on sale, right? Yeah, you can make money, but if it's not in alignment, it's not going to make sense. And it's not going to make sense to the people in and outside of your organization. When it comes to selling, the confused mind will always say no. So you don't want to be confusing in that and be misaligned in your strategic purpose and your core purpose for your business. Is it the same strategically if I make makeup business, if my makeup business online? No, not necessarily, Claudia, because you may have a different avatar online versus a different avatar that you're selling in person. So it just depends. Your marketing channel will matter. Like if you were going to be hosting a, like a makeup party. I don't mean to make it sound like something, childish, but we here in America, we do that sort of stuff, right? Well, they'll have jewelry parties, or they'll have makeup parties, or they'll do those sorts of things. But the avatar will matter. And and I will argue that generally selling in person, there's some salesmanship involved where you can generally probably sell for a lot more. Just saying, that might be the avenue that I would go. I could sell the heck out of some makeup. I'm sure of it. I'm not kidding. I could actually be pretty good at it. All right, but well, all the other thing is, because remember, what is it about? It's not about selling the makeup. It's about selling confidence, and that's what a lot of makeup does. So think about people, purpose, and then finally is promotion. The promotion piece is letting the world know what it is you're doing. Your external world, it's your promotion and it involves pricing. It involves a lot of different things around promotion, and also internally, it's about communicating to the people internally what you're doing. So you got to promote this thing all the time. So that is around the strategic planning when it comes to process. Again, we got tactical and we got strategic. Let's look at execution. Most plans fall apart in execution. And like George Patton said, General Patton, he said, a good plan violently executed now, today, this moment is better than the perfect plan next week. So don't let perfect be the enemy of done. Get things moving. A good plan is good enough most times. But the reason I bring this up is in part of the Viper methodology is because most plans fall apart in execution. And it's usually because folks like y'all, and I'm including myself in this, right? So again, if I had 3 hands, I'd have them all up right now. It's about having too many priorities. And because having too many priorities has the same impact as having no priorities, that's why many people are massively ineffective. Having that to-do list of 97 items that they're going to do today, right? And no one of them is delineated in terms of which one is most important. This is why I like to delineate a daily 5. And the daily 5 are up to, not more than, it doesn't always have to be 5, but up to 5 highly specific actions which will move the needle towards your vision or your strategic plan, either one. All right. So for me, the number happens to be 3, but I really, the daily 5 is totally fine. But again, the point is not having a daily 97 because, I know some of you are feeling convicted right now, but again, this isn't about judgment. It's about confession, because I used to do that stuff all the time as well. Let's look at the last piece, which is reporting. Reporting is just letting you know what happened. And you do that through lead metrics and lag metrics. Lead metrics are basically just the measurement of your actions and activities. Your lag metrics are the results of those actions and activities. And that's basically it. There's really nothing more. And the only thing that you can control is your actions and activities. I have zero control over who shows up to this. None whatsoever. I can put some marketing out there. I can put a compelling, ad together, but I have no idea who's going to show up. So my actions and activities have an indirect correlation to who actually shows up. But all of you could ultimately decide to, what, he's full of crap, I hate his face, and ultimately leave. I have no direct impact on that except my actions and activities. So this is why I'm saying, so don't get too hung up on lag metrics. Yes, measure your lag metrics. You absolutely have to measure them. But anytime you're not getting the results you want, you just have to look at your actions and activities. That's why I really like measuring just those 2 things. And we're going to be talking about more lag metrics here in just a few minutes when we get into the financial reporting piece. So this is the Viper methodology, Viper framework, and that is the Viper method. Now let's talk about the 4 core functions of business. The 4 core functions of business are lead generation, sales, operations, and accounting. And your customer's journey happens in that order. First lead gen, then sales, then operations, then accounting. And that's what I'm saying in everything when it comes to the 4 core functions. In terms of lead generation, everything needs to support this function. And for those of you who are on the call that maybe have a financial background or maybe have an accounting background, I have an accounting background. And guess what? When all the fighting that would go on would be between us and the people in sales, right? Now, because they were doing a lead generation function too. So those salespeople had to generate their own leads. But I was like, oh my gosh, are you kidding me? They would go out and spend all this money and bring in such little dollars. There was no profit in what they were bringing in. So there's always that battle between accounting and lead gen. So I'm just telling you, that you've got to recognize, and at the time I wasn't sophisticated enough in my knowledge around business to recognize that nothing happens until leads are generated. And the truth is this: you can have the best, most efficient business. You can be a paragon of truth and virtue. Your sales technique so dialed in that you could sell ice to Eskimos and voting booths to Castro, and you can still starve. And that's something that I missed for a long time when I was in the accounting world. I worked for the Marriott, and it was a wonderful business, but I was like a wonderful company to work for. But I was just like, oh my gosh, this is so frustrating, because I feel like all I'm doing is calling on these collections that they're creating. And it was terrible. I wasn't happy with the work. I mean, I love the company. Don't get me wrong. It was a wonderful company, but I just did not like the work that I was doing. So the truth is that you can never take your foot off the gas when it comes to lead generation. You can't. And the accounting function has to find a way to make sure it's funding that lead generation function. So when it comes to the sales just continues the conversation started by the lead function, right? And it understands that effective selling is obviously not just holding people's head underwater until they say yes. Generally, the operations functions, we talked about lead gen, we talked about sales. The operations is the fulfillment piece, right? That's where you're doing the actual thing. So if you're a roofer, this is where you get stuck doing roofing. If you're an IT person who makes websites, this is where you get stuck in the business making websites, right? So you got to be really careful about getting stuck in the operational function. And generally, here's the accounting function. And this is like the redheaded stepchild of all four functions. What generally happens is if you're going to ignore something, this is what you're going to ignore. And it generally goes something like this. Well, I've got more money in my bank account this month than last month. I must be doing okay. And I'm ashamed to admit I have a degree in accounting, and I have said those very words a number of times. I am the least qualified person to do the accounting and do the books in my business. I'm not saying qualified. I just know that I won't do it, right? So the accounting function should be very interesting to you. This is the function that collects the money. It pays the bills. It tracks and measures everything that happened, and it also forecasts budgets and plans for what will happen. That to me is incredibly sexy because I want to know, especially, okay, cool. And I'm looking at seeing stuff that popped up and happened over the last month, quarter, half quarter, or year to date, whatever it is. I'm looking at that so I can project what direction I want to go in or what I might need to tweak so I can go forward much more operationally efficient. That's what accounting does. So are all of these things the same skill set? Lead gen, sales, operations, accounting? No, they're not the same skill set. That's why business owners, specifically solopreneurs, struggle because they're trying to do all four of these functions. So outsourcing, finding help, getting other people to help you out is really where, especially if you're looking to scale or grow your operation, the best thing you can do to grow or scale an operation is to start hiring in people that can start to do these things for you. And most people think that scaling is about sales. Scaling is about the manpower so you can sell more. It's about bringing in the right type of people and bringing in high quality people that can do that work. And don't hand them a flat football with bad infrastructure and expect them to score touchdowns. All right, so we talked about the Viper framework. We talked about the 4 core functions. Let's talk about the financial statements. So the financial statements specifically, we've got a couple of different financial statements. There's the balance sheet and there's the income statement and P&L. All right, so let's talk about this really quickly. The balance sheet is, I'm gonna unpack each of these. But when it comes to the income statement and the P&L, if you've heard those two phrases, or sometimes you might have heard income statement, profit and loss, or P&L. Has anybody ever heard those phrases? They are all the same thing. It's just a different vernacular. I am an accounting purist, so I'm a little bit of a snob when it comes to this. I don't generally use the phrase P&L, and I don't generally use the phrase profit and loss. I generally use the phrase income statement. So I'm acknowledging in all of my accounting snobbery, that's probably the thing that makes me the most snobby. Okay, so don't judge me. So this is just making sure I'm keeping up with the. Okay, thank you, Catherine. All right, you're good. All right, so let's talk about balance sheet. Balance sheet is it's made up of 3 things. Okay, the balance sheet is made up of 3 things. It is made up of your assets, which is what is owned. What is owned. Your liabilities, which is what is owed to others, and it is the difference between those two is what the business would be worth, called equity, which is on paper. Okay, so generally what I want to make this point of is that balance sheet is generally, it takes a snapshot at one moment in time of what the business is worth. If I take a picture of the balance sheet, and I say take a picture, meaning like, let's say I go to my bookkeeper and say, hey, run a balance sheet for me, and it's at 8 o'clock in the morning. And then she spends all day. She gets some checks in. My sales guys make some sales. She pays bills all day. If she runs the balance sheet at the end of the day, it's going to be different because there was accounting activity. So I'm just letting you know that there is a difference between the time a balance sheet gets run. Now, generally, you might say, well, that seems kind of strange. Generally, you want a balance sheet that's where it's got accounts that are reconciled. So in other words, it's been checked against what the bank says that's in there. You say, yes, that's when it's in there. The accounts receivables all lined up. I'll go through this here in a second. But all that stuff is jived. Like, it can't be moved. There's no more money that's coming in or out during that period of time. That means all the accounts are locked and everything at that point is moving forward. So that's when you can print a balance sheet knowing it's not going to change, right? So let's go to the income statement or P&L. It is also made of 3 things. It is made of revenues, which is your sales, what you sell. It is made up of expenses, basically what you've paid out, and it is your net income. The difference between those two is your net income, what's left over. This is over a period of time, and it could be any period of time. It could be over 1 month, it could be over 1 week, it could be 1 day. Generally, you're going to see these over 1 month or 1 quarter or 1 year or year to date, right? January to, let's say, year to date today. So again, this is a little bit different than what the balance sheet is, where it's a snapshot in time and it's measuring different things. The income statement is actually over a period of time. Like what's the total amount of sales and expenses that you had over the month of January or the month of October, right? So that's how that works for there. So let's look at some specific examples of what the balance sheet is. So I'm going to get my giant dome out of the way so you can see this a little bit easier. And what I want you to see here, this is excerpted from the Time Wealthy Advantage from page 265, but this is a very basic example of what a balance sheet looks like. All right, so it's a very basic example, and I'm going to be going through these things right now. So you're going to see the assets at the top, the liabilities there in the middle, and you can look down at the bottom is the equity. You can check my math, I'm pretty sure it's right, between what the assets minus the liabilities equals the equity. All right, so let's go through the top section first, which is the assets. The assets, first and foremost, these are listed in order of liquidity, which means that the most liquid, the most convertible to cash is at the top. And this is what follows what's called GAAP, GAAP. No, it doesn't, like Mark, that doesn't spell GAAP. Well, that's how they say it. Don't beat me up. But so it's GAAP, generally accepted accounting principles. So when you're looking at your cash balance in your checking account, let's say that you've got a certain number, and this is, by the way, universal, whether this is dollars, whether this is Australian dollars, American dollars, or this is euros or pounds, it's all the same. So I just want to let you know that this is interchangeable. It does not matter. It is universal. It's generally accepted accounting principles internationally. So when you're looking at, let's say that you've got 10,350 pounds in Barclays, or you've got $10,350 in Chase Bank, whatever that is, it's in your checking account, that's what's there, okay? The accounts receivable is what money is due to the company. So in other words, let's say that you sell a number of widgets or a number of whatever the heck you're selling, and you have not collected that yet. You've got $101,275 out to billing to your customers, right? That's what's due to the company. That's all that is. That's all, and that may have anywhere from 30, 60, 90 days, and that's all across the board, right? So the vehicles that's listed there, you got a 2019 Ford van, that is going to be put in there at cost, right? That's known as book value. So for those of you who are maybe like, you've heard of maybe Kelly Blue Book value, it is not that. It's whatever you purchase it at, and that's where it stays in on the balance sheet. You say, well, that doesn't make any sense. Look, I didn't make the rules. That's what it is. When you're looking at real estate again goes in there at book value. Now, sometimes they mark it up to market, but I'm not getting into that right now. So the total assets altogether are $417,095. So if you notice, it went from the most liquid down to the least liquid in terms of assets. Now, notice what else isn't on here. There's no leases that are on there, right? There's no leasehold interest stuff. It's only specifically the balances of things that you own, and it's the balances of what you own, right? Or basically what you own is as an asset to the company. So that is the assets. Again, that's at the top of the balance sheet. Let's look at the liabilities function. Liabilities is, again, it's just a snapshot. It's just a balance of one moment in time, and again goes from shortest term to longest term, right? So again, you can think of this in terms of liquidity. You got credit card balance of 34,000, accounts payable 37,000, right? Payables are what is due out to vendors. That, let's say that you buy raw materials, and that is what's being paid out. You got a Wells Fargo van loan, or that could be Barclays, or again whatever loan, and then Citibank real estate mortgage, which is tied to that warehouse that you have. Those are the total amount of the equities, and then the equities, the assets minus the liabilities equals the equity. Right? Assets minus the liabilities is what equals the equity. So on paper, the business is worth not quite $250,000, right? 227,000. All right. So that's that. So that is the basics of the balance sheet. So hang in there, because we're going to get through the income statement, and then we're going to get to some of the important metrics that you need to track to make sure you don't grow broke. So just hang in there. So the income statement, again, it's about the revenues at the top, expenses in the middle, and the wages at the bottom. So let's just say this is over 1 month. So in terms of the product, the revenues, I've got product sales of 75,000, service sales of 39,000 equals total sales of 114,000. Now you see those percentages that are off there on the right-hand side. We're going to come back to those in just a little bit, because that is what's really important when you start looking at these things like a true professional, like a true money professional. And this is going to take your stuff to the next level. So hang in there for just a few more minutes. So we talked about the revenues. Let's talk about the expenses. The expenses, again, are what you've paid out over that period of time. So let's say over that month's period of time, say in October or November, we'll say October, you had $34,000 worth of raw materials that you purchased. You have insurance expense of $5,000 and interest expense of $2,000, et cetera, et cetera. And all of those expenses sum to $96,000, and the revenues minus the expenses equals a net income of just under $18,000. All right, so that is the income statement. Again, income statement, P&L, profit and loss, they are all exactly the same thing. All right, so what does this mean? Why does this matter? Why should I care? What does it have to do with the price of tomatoes? Look, the end of the day, when you understand your financial statements, and really you might be thinking, okay, well, this is great, but where is all of my cash going? Like, why do I feel like, and especially for those of you, this might be something that you experience if you've been in business for a while, like, oh my gosh, where is all my cash? I have grown this business, but I actually was making more money when I had fewer people, when I was doing lower volume. What is happening? Well, this is the issue. These are all the basics right now, so we can be a little bit more strategic with our finances. And this is about becoming financially literate. So especially understanding balance sheet and income statement. You don't have to know debits and credits. You don't need to know what a chart of accounts is, although that would help you. You don't necessarily need to know all of the intricacies of how to do journal entries. You don't need all that stuff, right? Not as a business owner. If you're an accounting person, yes. If you're a bookkeeper, yes. But if you're a business person, you don't necessarily need that. You just need to understand what you're looking at when your bookkeeper or when your accountant hands you stuff. You have an idea of what it is that you're looking at. And don't just go by what they're telling you. You need to be doing the analysis, because they are not generally analytical people. I mean, they're analytical. Let me put a caveat on that. They're not strategically analytical. Being strategic is a different skill set, and most of them are not strategic. They're just going to keep you compliant. That's a big difference than being strategic. So this is where the good folks like Clara, I give her a ton of credit, who's on here saying, you know what? I'm a master's student. I got some street cred, but I don't know it all. And here she is. I love that. And I'll tell you what, when I was able to set that stuff aside, I'll tell you what, I mean, I'm a PhD student right now for organizational psychology. Man, I am made of questions. I have no idea what half of it is that I'm reading, but that is making my growth so much faster because I'm able to set that stuff aside. So let's talk about growth planning. You cannot be strategic if you don't know your numbers. There's just no way around that. There we go. So it's really hard for you to be strategic if you don't know that. And this is why it's important for you to know these things so you can avoid growing broke. All right. So in terms of the three key metrics that we're going to be talking about right now, first and foremost, we're going to be talking about profit margin percentage. Then we're going to be talking about cash balance history, and then cash as a percentage of sales. These are three important metrics. I don't care what business that I've ever been involved in. Anytime I get hired in as a strategist, these are the three numbers that I'm going to look for right out of the gate when I'm working with a new organization, because I'm telling you, most time this is going to tell me a lot. This is going to tell me a lot of the story of what's going on. Thank you, Clara. Yeah, totally agree. Yeah, same with me. I mean, things really changed for me when I was able to set aside my ego. All right, so let's talk about profit margin percentage first and foremost. All right, so remember over here we have the income statement. I'm going to get my head out of the way here again. So what we're going to be talking about here is these. If you look at the screen, do you see that what I circled on the right? This is known as percentage of sales. This is known as percentage of sales. Now look, I'm on the income statement and I'm circling those percentages on the right. That is a percentage of sales. So what that means is, let me just go to the next screen so you can see. You see where I've got the percentage? So I got the revenues up there where 75,000, 39,000. And if you're looking at the total is 114,000, but 75,000 is 65.8% of 100, right? It's 65.8% of the 114. And 39,000 is 34.2% of the 114. You might say, well, why do you care? Well, if you know that your margins are thicker on service sales, you'd want to increase your service sales, or vice versa, right? You know, if you know that you have heavier margins on one product or service, or one area or the other, you may want to do more to promote that. So when I'm looking at, and let me go back to this real quick. If I'm looking at the expenses, and right now I know it might be a little hard for you to see, but if you're looking at raw materials and you say like, okay, that's 29.8% of sales. If your sales start to grow and you're trying to compare them to apples, I would be looking at those percentage numbers, because let's say for argument's sake that next month total sales went to 128,000 and my raw materials went to 39,000. Is that good or bad? Well, it's hard to know, because you're like, well, yeah, raw materials went up, but so did sales. But when you know the percentage of sales, now you have an apples to apples comparison. Does that make sense? So that's why this is really important for you to know and to track this. And if you get nothing else from this training, please make sure that whoever's putting together your income statement is tracking this stuff or printing this stuff off for you, so you can track it from month to month or from period to period. That's going to be the biggest thing. And that's exactly what fractional CFOs do, chief financial officers. This is the stuff that they get paid a lot of money to know. And you just got basically a master's degree in about 30 seconds. So this is really important. So when you're looking at the income statement, again, we're just going to look at the total sales. And again, when I go all the way down to the bottom, I'm going to circle that number that says right by the net income at 15.5%. That is the profit margin percentage. Now, let me make this quick point here. If you are trying to avoid growing broke, you have to be on that number like a flipping Band-Aid. You cannot take your eye off that number. Profit number is great, but profit margin percentage is what's going to keep you from growing broke. Your sales are going up, but you're making less dollars. That sucks. I don't know about you, but I don't want to work more and make less. So this is why when you're paying attention to these sorts of things, this is how you avoid growing broke. So let me get myself all the way out of the way. You're going to be paying attention to profit margin percentage. So when you're looking at profit margin percentage, I'm going to use this as a very simple example. And this is about how efficient the business is at keeping dollars. So this is a very typical thing that I see businesses do especially when they're in a highly inflationary environment. Let's look at this very simple example. Let's pretend that your revenues are $10, your expenses are $8, and you have a net profit of $2, which yields you a net profit margin percentage of 20%. Straightforward. 2 divided by 10 is 20%. Now, let's pretend that your expenses go up by $1. Let's say they go up by $1, so they go to $9. And you want to maintain your net profit margin of $2. So you raise your prices $1. So you go from $8 to $9 and revenues from $10 to $11. So let's see what that looks like. So you go from $11 minus $9. Great. You maintained your net profit of $2, except look at what happened to your net profit margin percentage. It went down. It went down 18.2%. Congratulations. Your business is now less efficient at keeping dollars. That sucks. And that is how you grow broke. Because again, you raised your prices, but you are making no more. You're making the same dollars. But if you're in an inflationary environment, you're actually now have dollars that will buy you less. And that is exactly how companies often grow broke, is they just raise prices just enough to maintain the profit amount, not the profit margin. That is critical. So what should they have done? Well, they should have raised the prices by $1.20. $1.20 would take it to $11.20 minus 9, which yields net profit of $2.20, which is what? A 20% profit margin on $11.20. So what I'm saying is, this is also why in periods of high inflation or just an inflationary environment, this is exactly why companies on Wall Street do really, really well, because they raise prices recognizing that they're going to be making more dollars, but they're also going to be more efficient. They're going to maintain the same efficiency at making dollars. That's what's really critical. So Claudia says, I am new to all of this. Okay. So how do you get the percentages for the expenses? So what do you do? I mean, if you want to do it manually, let me make sure I'm answering all the questions here. Hang on one second. Claudia asks, what is your opinion on Monzo business account with the financial accounting app built in? I'm not familiar with Monzo. I'll have to look that up. It's a really good question. But if it's got the accounting and it's truly built in, that's fine. But I'm just telling you, if it's probably free, it's probably not giving you everything that you need. I'm just telling you, like, for what QuickBooks or QuickBooks Online, I'm not a fan of QuickBooks Online, but it's actually okay. But QuickBooks on desktop is really, really good. I like that one just because it gives you everything that you need. And if you want these profit margin percentages, it's literally checking a box in the settings. That's all it is. It's not hard to do. If you want to calculate it manually, you literally just take the expense line item, divide it by the sales number. That's it. It gives you this profit. It gives you the sales as a percentage, or the percentage as a percent. Oh my goodness. It gives you the expense as a percentage of sales. So the expense line item, right, divided by, so let's say if it's 10,000 divided by net sales or gross sales of 100, it's 10%, right? That's how that works. So Catherine would ask that question. I'm new to all of this. Very good. Peter says good. Not sure what good was, but thank you. Clara, Catherine, just sharing. I think those percentages for expenses equals expenses divided by total sales. That's exactly right, Clara. Yeah, you should be teaching this. I'll go away. You're good. You're all into this. Yep, you guys are coaching each other. Perfect. All right. So I know some people have popped out and popped back in, so it's good to see you guys. Remember, if you have to leave, I totally get it. I know some of you are in different parts of the world, and this will be sent out to you on in your emails for the replay. So I just want to make sure that you know about that. All right, so let's keep this ball rolling. So this is exactly how you avoid growing broke. So this being on top of that profit margin percentage is one way that you can avoid growing broke. And I'm telling you, you have to be on that like a flipping disease. You cannot let up on that. So the other thing I want to talk about is we talked about the net profit margin percentage. I want to talk about cash balance history and cash as a percentage of sales. Cash balance history is pretty straightforward. Let me go ahead and just take myself down so you can make sure you can see this. But it's literally just tracking your cash. And I know this is all available on your balance sheets when you just print it out, but I want this stuff readily available on a flash report that my bookkeeper, or maybe I'm the bookkeeper right now, but I want to know from 1 month to the next that what my cash balances are. And I don't care if it goes up by $1, it better damn well go up, because when you have a healthy cash balance, it gives you options. If you don't have cash, you don't have as many options. And I'm telling you now, as crazy as it is, and I was in the banking world for a number of years, banks will loan, or much more likely to loan money with people who have cash in the bank. And you go, well, I don't have cash in the bank. That's why I need a loan. I didn't make up the rules. I'm just telling you that they are much more likely to loan you money when you have cash in the bank. And why not preserve your cash and your capital if you can be profitable and use someone else's money to do it? So I'm just telling you, at some point you can get to listen, if you don't believe me, look at some of the largest companies out there, the healthiest companies, the ones with really, really strong growth. Look at Southwest Airlines, look at Google, look at Facebook, look at Microsoft, look at Berkshire Hathaway. I mean, they had they're worth almost like what, $750 billion last time I looked. And about a third of their total value was in cash and cash equivalents. I'm not like, that's crazy. That's a lot of cash. And the reason being is because the healthiest companies can take advantage of good luck events when they come along, and they can weather bad luck events when they come along. And the storms come. Anybody who has been in life for more than 11 minutes knows the storms come. And sometimes they come, and sometimes they last for a while, and sometimes they just blow through really fast. But I'm just telling you, when you have cash, you have options, and it helps you weather those storms. So this is why, again, cash balance history is one of those things that I track, again, just all the time. I want to make sure that I'm tracking my cash and it's going up. This next one, cash as a percentage of sales, it's going to take a little bit of maneuvering on this one, but this is one that I really like to track because it gives me an overall sense of how much cash I have based on my operational functions. We can do this. We can do hard things, right? We're almost done. We can finish this up strong. So what we're going to need, you're actually going to need two numbers from the two different financial statements that we talked about. So Catherine says, amazing. Thank you. Oh, okay. Yep, you bet. I'm not sure who that was for, but you're welcome to whoever. Claudia says it's not free. The financial accounting, I would have to pay a certain amount per month. Okay, and it's probably worth it then, to be honest with you. But I'm just telling you that there's a lot of those free ones. They're good to get started with. I'm not saying you got to go out and spend a bunch of money, but you get what you pay for and that sort of stuff. And usually it's pretty, you don't get a lot of support. And if there's any bugs in it, you don't. I mean, I just want stuff. I want to know that my numbers are solid, and I don't want to have any questions about what's going in. So let's look at cash as a percentage of sales. So again, we're going to need two different things here. I'm going to take myself down out of the equation here. So we're going to need the cash balance from the balance sheet, which is right up there. Okay, so the cash balance from the balance sheet. And then we're going to need is the total sales number from the income statement. Now, here's where it gets a little tricky, is it depends on your business cycle. So most business cycles have like a 30-day cycle. Some businesses have like a daily cycle, like maybe like a coffee shop, right, where they have a daily cycle. Personally, like again, I have several real estate businesses. I have my own rental portfolio, and I also have a property management business. That money comes in once a month. So it just depends on this. So let's just pretend, to make the math easy for right now, that if you like, for a farming operation might be every 6 months, right? Just because depending on how their money comes in, right? So I'm in the Midwest. We have lots of farming operations around here. So let's just say, for argument's sake, just to make it nice and easy, that it is a monthly nut. So the reason I'm bringing that up is because I would want a monthly income statement to track this. So what I'm taking is, I'm going to take the cash, like I said, from the balance sheet at the end of the month, reconcile balances. So let's say it's 10/31, the end of October, and this is for the month of October. So let's say 10/1 through 10/31. So it's the full month of October. So now what I'm going to do is I'm divide that 10,000 divided by 114,000, which is 8.7%. Is that good? Is that bad? It's not good or bad. It just is. But this is what I'm saying. I'm also going to track that number. So I'm tracking that number. Now look at what it was in January. It's 8.7 in January. It's 9.2% in February. It's 11.3% in March. Now, keep in mind, you got to recognize that just because it's going up doesn't necessarily mean that it's good, because it's a function of two different numbers, right? It could mean that the cash is going up, but it could also mean that sales is going down, right? Which is fine, because if you're in every business has a cycle generally. So like in, your business might be in a lull. So you're seeing the cash going up, which isn't necessarily a bad, or you see the cash as a percentage of sales going up because sales is declining. But the good news is that you can weather that storm. That's an important thing. So that's why I always want to be able to know what the number is, but I'm also tracking those numbers. That's a really critical number for me, because it gives me the overall health of the business, not just looking at sales numbers and profit numbers, but I'm also looking specifically, how long do I have? Like, for example, if I had, let's say all my sales went to zero, which is pretty unlikely, but let's say that all my sales went to zero, would I be able to fund my expenses for a period of time, right? So this is why I want to know. That's just a measure that I use, as cash as a percentage of sales. It's just one number that I really like to track. So that's it. So this is the thing right here. You cannot be strategic if you don't know your numbers, and you have to know which numbers to pay attention to avoid growing broke. For me, it's about net profit margin percentage and my net cash. Those are two critical numbers that I need. So let's talk some success strategies. You got to know your numbers. You got to track your numbers. There's just no way of getting around that. You have to know them. So we are done here at the end. I want to end with a funny story. For those of you who've ever seen this photo, this is, or if you've ever seen me in any of my previous seminars, webinars, this is actually a photo of a guy in Pittsburgh who was robbing banks over a period of a couple days. He and his buddy were in Pittsburgh, and they were robbing people at gunpoint with no attempt to disguise who they were. They didn't have a ski mask or anything else on like that. And what they eventually caught these guys in like 2 or 3 days. I mean, it was pretty easy to find them. Well, the funny thing was, the bank robbers they could not believe that the police found them. Because what they did to disguise themselves, I'm using air quotes if you can't see me on camera, but what they did to disguise themselves is they put lemon juice on their face, thinking for sure that it was going to make them invisible to the cameras. I'm not kidding. It was such a story, in fact, that people thought this can't be true. So it actually, these two researchers that we have to investigate this further. This can't be true. So these two researchers by the name of Dunning and Kruger, they came up with this and understood this phenomenon, and it's known as the Dunning-Kruger effect. So if you look at the bottom, let me get myself completely off the screen here. If you look at the bottom, this is basically you've got your competence, right? Your knowledge along the bottom axis, the x-axis, and along the vertical axis, the y-axis, you've got your confidence. And the interesting thing is that when you're looking at these, what goes on with the when you're starting out with something, generally it starts out with, well, how hard could it be, right? How hard could it be? Like, what is there to know? So generally you start here at the bottom, not really knowing much, but your confidence like soars immediately. And you get to what's known as the peak of Mount Stupid. And all of a sudden your confidence is super high. And then you realize, wait a minute, I don't know what I don't know. And that's when you start this long descent. It's usually pretty rapid. It's usually pretty fast, but it is a long descent down into the valley of despair. And this is where a lot of people often stay. And this is where, for those business owners and entrepreneurs out there that tend to have shiny object syndrome, running from one idea to the next, to the next, to the next, this is often where they abandon whatever idea they have and go on to something different. So then if they stay with it and they start putting in the work and putting in into their education and demonstrating more and more competence and learning more competence, they start up the slope of enlightenment. And eventually, if they keep at it, they will get to the plateau of sustainability, which is there at the top. So it's just interesting that this is what happens when people, a lot of times they just get frustrated, they leave, they abandon things too quickly, and this is what ends up happening. So my suggestion here is to have a support system. And this is something that I am offering to you guys. If you are interested, right now, there's no cost just to be in the community. If you are looking for something more, there is a cost to it. But I'm just letting you know, like, if you are interested in the school community, I'm just going to go ahead and put the link in the chat right now. Oops, hold on one second. Sorry, this is not working with me. There we go. So I'm going to put the link in the chat. If you want to go to school community, I like this community a lot just because it does not, it's not distracting like Facebook groups or anything like that. And it doesn't bury anything in there, next to, Aunt Sally's rhubarb pie and everything else. Like, this is it's really kind of nice that it's in there. So if you guys want to go in there and check, just click that link. Like I said, there's no cost to just be in the community. If you are wanting the higher level stuff, yes, there's cost to it. But right now, just what I would just suggest for you right now is just to go in the community and check that out. And that way we can stay connected if you've got any questions. So that is all I have, everyone. Thank you so much for sticking around. You guys were a very lively group. Usually I don't get this kind of a lively group in a financial literacy session. So you guys were super chatty. I really enjoyed hanging out with you guys tonight. Thanks so much for sticking around. And you go ahead and look forward to the replay in your emails. And yeah, my pleasure, Catherine. Absolutely. My pleasure, Peter. Thank you. All right, guys, have a great rest of your day, and we'll see you guys next time. Thank you, Alec.